You are sitting alone in front of a glowing monitor, staring at a screen that says you just turned $500 into $5,000. For a brief moment, the market seems to be rewarding your intelligence. It feels as though months of studying charts and analyzing trends have finally paid off in a single transaction. But for the vast majority of people who experience this specific high, the victory is short-lived. This sudden financial milestone is rarely the start of long-term success. Statistically, the most devastating financial losses a trader will ever experience occur immediately after their most profitable trades. The extreme high of a massive windfall masks a subconscious shift in behavior, setting a psychological trap that quietly guarantees ruin. The next day, you sit back down at the desk. You execute trades faster, operating under a newfound sense of total control. Your brain stops seeing the previous result as luck within probability. Instead, you start believing a different narrative. I understand the market now. This belief quietly alters your operational behavior. You begin trusting your gut instincts rather than adhering to your established trading rules. The logic seems reasonable. If I made $2,000 with this size, I will make $4,000 if I double the initial capital. This expanded risk threshold completely eclipses the structural stability of the original trade model. A carefully calculated trade becomes an emotional bet. This unearned confidence transforms a systematic process into uncalculated gambling, often without the trader even noticing the transition. The screen fills with active orders as you begin opening multiple overlapping positions with increasing aggression. You start attributing this winning streak entirely to personal skill. You ignore the possibility that the market was simply trending strongly, or that the volatility, the degree of variation in trading prices over time, was temporarily working in your favor. Strict rules suddenly become flexible guidelines. You skip technical confirmations, you enter trades earlier than planned, and you drastically increase your leverage. Leverage is the practice of using borrowed capital to amplify potential returns. The trades are no longer about calculating mathematical probabilities. They are now executed solely for the purpose of proving you are right. Bringing an inflexible ego into a highly fluid, unpredictable environment creates a massive vulnerability. Eventually, the market changes. A sudden reversal, a sharp volatility spike, or a fake breakout turns a perfect setup completely against you. Because your position size is now heavily inflated, the financial impact of this downward swing is instantly magnified. Instead of calmly accepting the loss, you react emotionally. You hold the losing position longer, and you average down. Averaging down is the strategy of buying more of a losing asset to lower your average entry price, hoping for a rapid rebound. What started as a mathematically manageable loss rapidly snowballs into an account-damaging event, and sometimes a complete financial wipeout. Markets mathematically punish certainty, ruthlessly extracting capital from anyone operating with unchecked size and rigid assumptions. To recover from this, you have to return to a state of cold, methodical, and emotionless analysis. The market does not care about your last win. Every single trade is an entirely independent event. This is a scatterplot representing hundreds of individual trade outcomes, displaying a slow, steady upward trendline. Professional traders only increase their position size when their statistical edge, a verifiable advantage that yields a positive expected return, is proven across hundreds of consecutive executions like this. Now the chart adds two contrasting lines, a rapidly spiking curve representing confidence and a slow, gradual growth curve representing skill. Your position size should grow slower than your confidence, because if size scales faster than actual skill, the market will eventually collect the difference. The goal of trading is not to feel smart for 1 week. The objective is to respect risk management deeply enough that you ensure your survival over thousands of trades.